In this episode, Ryan and I discussed the infinite banking concept compared to what? We had fun. Hope you do too. Thank you for listening. Welcome to the Banking with Life podcast. I'm your host, James Neathery.
And I'm your co-host, Ryan Griggs.
And we're excited. I'm excited. You excited?
I am. What are we talking about today?
You know what? We just had a lengthy conversation about what we were going to talk about.
So we should have it again.
So we scrapped the list, and
this is our show. We can do what we want.
That's right. You're the banker. The banker can do whatever he wants. Okay, so we're going to talk. We're going to talk today about third-party capital, and really, the infinite banking concept compared to what?
Yeah.
Right. But we're going to specifically talk about third-party capital and all the machinations that exist out in the big wide world. Mm. There's so many ways to do things as far as accessing capital.
Right.
And quite often it's like when it comes to the infinite banking concept and you're speaking with someone, it's like, well, man, I can get I can go borrow money at 3% or 4% or 5% or... They never want to talk about the 29% credit card balance that they're carrying and have been carrying for 20 years. Right. Or the
truckload of dollars they're losing on the mortgage.
Well, but it's at,
4%, 3%.
Yeah, 4%.
So this is how this came up, right? So different people will ask and they're good questions, not saying it's a bad question, but they're saying, well, if I could take a policy loan at 5 from the life insurance company, but the auto lender is going to give me the car at 2% or 0 or whatever it is. And we'll suppose for the sake of argument that these are genuine numbers, right? They're not just smuggling the interest cost from the rate to the price, right? So we'll suppose they're not doing that. Probably are, but let's stack the deck against.
That's the only way you can get to 0% interest or 1.999.
Yeah, free money. Wonder how that happened. Yeah.
Hey, the ECB just lowered interest rates to 0.
All of Switzerland's. Here we are in what is this? September
2019.
All of Switzerland, the entire bond portfolio of the Swiss government, all of them are negative. Negative yielding.
Well. Munchausen,
whatever.
By proxy. The Steve guy,
Steve Mnuchin.
Yeah.
Treasury Department.
The Goldman
Secretary.
Sachs, we rule the world. Goldman Sachs, ex-president, right? Mm-hmm. He's talking about throwing out a 50-year bond. The U.S.
Why stop there?
The government needs a 50-year bond.
Yeah.
There's a demand for 50-year bonds.
James Grant mentioned that it's being thrown around again in the UK, the idea of a release of a perpetual bond.
Yeah. Wait.
No maturity.
Right.
It's just
Didn't
forever.
the Romans have that?
Just give us money forever.
At no cost. Or next to no cost.
Okay, so there's all these. Can I get, why should I do IBC? Is it a reason to not do IBC? Because there's what ostensibly could be cheaper money relative to a policy loan, right? And so that's on the lending side. Then there's the growth side. Is it because, again, supposing it's true that you can actually get, say, 1% a month or Bernie Madoff style numbers, supposing all the financial entertainment about the alleged returns on average you can get in the stock market, supposing that's all true, supposing the growth really is better, is that a reason to not do IBC? Shouldn't I just be investing? So compared to what? And I think that's actually really the problem, is that we don't know what to compare IBC to, and so many of the comparisons that people end up using are apples to oranges comparisons.
No question. Well, even in the infinite banking world, you get into a lot of that apples to oranges comparisons. But okay, so we have the growth side. What if I can really go earn 12% year over year for 30 straight years and forever? That's one side of it. The other side is the cost of capital, right? So why should I borrow money from the life insurance company? You said at 5, right? Which is most of the companies we work with, it's right at 5 or a little over or a little under. But there are lots of life insurance companies out there that they have fixed loan rates at 7, 8, 9.
Mm-hmm.
All right. So on one side, there's a cost of capital. Shouldn't I use a third-party lender's money if I can get it for free or zero or next to zero, compared to accessing the life insurance company's money at 5 or more? One side, and then the other is, well, I can go get a 12% rate of return or whatever. I mean, so when you compare it to what, and I completely agree with you. Most people, I don't want to say most people, but it is very difficult to compare the infinite banking concept, what we're doing, and then what you can do with life insurance structured this way, with all the other options or choices out there. I mean, it's very difficult to compare apples to apples. But okay, so it's hard. How do we fix that? You know, what do we do? I mean, it centers in our thinking.
Yeah.
You know, and how we even think about capital formation, capital accumulation, access to capital, and then deploying the capital in all the choices that exist. So, and then, you know, so let's just break it down.
Yeah.
You know?
So Nelson used to say, you know, it's all about how you think, rethink your thinking, and that's why I harp so much on capital. Right? What is the infinite banking concept? In my framework, in my view, it is the optimal method to use and accumulate capital. The optimal method to use and accumulate capital. So we're capitalizing, you could say. We're building capital. The IBC is a capital strategy. That all falls under that umbrella. Now, with that in that frame, now we can put the other things, right? So is, for example, a tax-qualified plan a capital strategy? No. Tax-qualified plan is a form of investing, right? Method of investing. A very close to the government method of investing.
Well, it's close to the government because they created that exemption,
right,
or allowance. Right.
And so there's other. So where would a auto loan fit relative to the infinite banking concept? Well, an auto loan is just a method of using somebody else's capital, right? And then, so again, IBC, a method of using and accumulating your own capital, right? So, and I've heard you say this before in the past too, and I've told people, it's like, you know, bankers do business with other bankers all the time.
Every day.
All the time. So there's no reason that you can't be your own banker, participate in infinite banking, building and accumulating your own capital in the optimal method and fashion, right? And also then go use, as we're saying, for the sake of argument, the cheaper money, right? The allegedly 2% auto loan or the whatever else it might be, right? In other words, it doesn't hurt to be fully capitalized, fully collateralized, so that if something were to happen to that loan, which, you know, there's never, like you say, there's never a problem until there's a problem. But when there's a problem, might need a solution. Right.
So when there's a problem, and you're talking about banks and bankers and banking and lending and repaying, there's going to, you know, their assets are going to swap hands.
Yeah.
When it goes bad.
That liquidity trap sets off.
All right. Well,
people don't have access to capital because they don't have a strategy to accumulate their own.
Yeah, no question. In which that, you know, proper capital formation.
Yeah. So with that in the background, though, a thing that comes up a lot is, well, shouldn't I do a HELOC?
Oh, that's recent. Oh, my gosh.
I'm going to get into a HELOC. I'm going to get out of my mortgage. I'm going to go do a HELOC.
Well, let's just
run all my income through the HELOC.
Yeah, well, shouldn't I do that with infinite banking anyway? I mean, you know, it's like, listen, all right, for me, all right, break it down simply for me. Let's start. Everything you purchase is financed, all right, whether you formally finance it with third-party lending or you pay cash, it's being financed, all right. And now we have to at least agree or be aware that capital has a cost, all right. Okay, so now let's just get right into financing in current modern times. You know, I can go finance a new car, and my wife and I, we just purchased a new car, you know, a couple of months ago.
Did you use a policy loan?
Well, we can talk about that. Yeah, we could talk about that. But then not auto. No, they're new cars, right? New car, and then pre-owned cars, right? And now I think the interest rate that was offered whenever we purchased the new car was 3.79, right? And to directly answer your question, I did use a partial policy loan because I did finance the down payment through a policy loan, and I financed the rest of that cost with that third-party lender's money. But rest assured, there's enough cash value in the policy that we financed the down payment. We could have written a check for the car. All right, so. And I know. Listen, Nelson. Listen.
You're saying you had the authority to choose which method of financing you preferred,
and I had the ability to choose. And now, what's more important, the ability to pay your house off, or actually paying your house off? I don't know. The circumstances are different in all of our cases. All right. I know it's important if something goes wrong and the bankers show up, the third-party lenders, whomever they are, and they're wanting to call notes or loans or seize assets, I could just say, no, thank you. Get out of my office. All right. When I was growing up, my dad, God rest his soul, great guy. I wish you all could have met him because you would have liked him, I think. He used to say when he was young, he said, James, when I was young, I had to go to the banker with my hat in my hand, and I had to ask them permission. Right, so he graduated very early, but in his life, but it was about 13 years ago, right? And so about probably 25 years ago, I'm a little bit older, maybe not even that long. Early when he was young, James, I had to go to the banker with my hat in my hand because I had to ask them, right? Later in his life, God, I love him, right? He said the bankers came to him with their hats in their hand. I don't know. Who do you want to be holding the hat? You or them? So my point is this, that, yep, we used a policy loan for a down payment on the car.
Yeah, you used a mix. Their money, some of the life insurance company's money.
And I could do whatever I wanted, and it was by demand, right? I mean, I wasn't demanding at the dealer, but damn near. This is what I want. And they went out and got it. Great dealership,
Yeah.
Tier 1 treatment. Oh, here, Mrs. Neathery and whatever. And, here's, you sign all this stuff. Here's the rate. Sign all this stuff. Do you want to pay anything down? Or I don't even know if they asked that question. I told them this is what I'm going to do and this is what I want. And they delivered, right? And so my wife's happy. She's driving what she wants, the color, everything. And she has a monthly payment, not me. Right? And part of it's going to the third-party lender. I don't even know what bank it was. I could care less. And part of it's going to the life insurance. The same way no. I was going to say the same thing.
When you want to repay that policy loan, they'll get they'll get the interest. They'll get the.
She better not make late payments. Anyway, but we talk about cars at 3-point-something% interest on a new car. You cannot go buy a pre-owned car for 3-point-something%. And if we really think about it, they're lending money that didn't exist anyway. What does the capital really cost them? Now, mathematically, am I paying more or less interest if I use a third-party lender's money at 3.8 or whatever it was? Mathematically, I'm paying less money than, or on the obverse, I'm paying more interest to the life insurance company. Well, okay. Mathematically, numerically, the cheapest cost of capital is numerically the cheapest cost of capital. Does that mean it's the right thing to do every time, all day long? No. There's other times too, and I know we didn't really talk about this, but the last real estate deal that I did, all right, And we got to go back a few years, and back then there was a lot of noise in the infinite banking world about, oh, this company doesn't allow first-year policy loans, or that company doesn't allow first-year policy loans. You know what? Once a policy is issued, it's a unilateral contract. It's Einbahnstraße. It's a one-way street, right? So if I have a contract and the company says they don't allow first-year loan, maybe that's in the contract. They don't allow first-year policy loans. Can I just take that contract right down to the bank if I have an educated banker and say, look at all this capital right here that I don't want to interrupt the compounding growth within this policy. How much will you loan me against that policy? All right. And so I did that on purpose. I bought we bought a piece of real estate and used policy loans to do it, and I used a first-year policy to do it with a company who does not like first-year policy loans. And I had conversations with Nelson, and and he knew what I was doing, and we talked about it. And myself, I'm thinking, oh, this will be the greatest thing ever. To demonstrate that you can use a policy in the first year, even if the company doesn't allow a first-year policy loan. Then I took the opportunity to educate my young banker because my previous banker for 40 years had died, so I was orphaned. And so the great young man comes in, and he's like, I'm your new banker. And I'm like, how long have you been doing this? He said, 12 years. He looked 30, and I'm like, questioning him. He's a great guy. And I've told him all this, right? And he listens to the podcast too. So, hello, Bobby. And so, Nelson's like going along. He's like, yeah, you could do all that. Makes sense. I understand why you're doing it. And so I did it. All right. So we purchased real estate as cash. And that's an interesting story in and of itself. And I didn't really mean to talk about it all right here.
Yeah. Well, that's a good example of how you can use capital you own.
Well, and it gets better.
Collateralize it with the life insurance company. Collateralize it with the conventional banker. Right? You can choose.
When's the last time you've been in a position that it's your way or the highway? Isn't that where we all want to be when it comes to money and everything else? I want to do things my way.
I truly don't even think it's on people's radar. Like, that's possible.
Yeah.
You get the credit card offers in the mail. The lender tells you what they're willing to offer. And it's just kind of assumed that this is the only way to do it.
And you wake up and you've got 10 years of contributions to an IRA or a 401k, and you're a young person. You can't access more than half of that, or $50,000 to a loan, or it's going to be penalized. Of course, it's going to be taxed. It's always going to be taxed, and it always goes back to the question, would you rather pay taxes in a known bracket or an unknown bracket? And I'm not advocating that you start the infinite banking concept by making withdrawals from your qualified plans. That's not me.
Though it's possible.
It is possible. While everybody's contributing to their 401k and their IRA, then we're dependent upon third-party lenders. That's the norm. So I want to get the cheapest rate possible, preferably zero, which does not exist naturally on the face of the earth.
That's why we're in this situation. That's so good. And Nelson talks about this in Becoming Your Own Banker, about in the part about the golden rule, right? He who has the gold makes the rules. And that is what has happened over time. Individuals, and I think there's really something that you could do, like academically here. I think this could actually be like laid out very specifically. But over time, people's control, the scope and quality of their control over capital has been crushed, diminished
on purpose.
So the individual's level of purchasing power, literally the ability they have to go out and purchase, right? Their power to acquire things, which is their control over capital, right?
Part of it.
Capital is it represents your ability to purchase, right? So as people are squeezed on their control of capital, their ability to mobilize resources has diminished, and it's been concentrated in the hands of the politically connected and elite. And so no wonder the rest of us are looking around for scraps. You know,
political elite that's connected to the bankers.
Right.
Yeah.
So that's why we're in a position where I got to make sure that is it 4.5 or is it 4 1/4? Like what's the that's why we're in this position where we have to be so mindful of the cost of money, is because we don't have much control over it to begin with, and that's really what we're reversing. And I think that for most people, like for people who have done infinite banking for a while, they're like, yeah, who cares about the interest rates, right? I do not care, right? And I tried to communicate this to someone who was considering the infinite banking concept. I was like, this is all great, and did the spreadsheet, wall of
4
numbers.
pages.
Oh my gosh,
4 years.
Yeah. I was like, this is fine, and I'm sure you're gonna validly demonstrate what Nelson's already demonstrated in that way, and that's good. Maybe. Some people are analytical. I don't want to be hard on them, but you can spend a lot of time in front of a computer attempting to prove something to yourself that maybe has already been done, right? So I try to communicate to him, look, as we get down the road, 5-10 years down the line, you're just not going to care. You're not going to want to deal with it. I could see a scenario where it would be like a little offensive that someone's going to ask or require an application and inspect your character. It's like, excuse me?
2 years
How
tax
about we
returns.
don't and say we didn't? Right.
Can I get all your K1s?
Yeah. It's like in a sense, you get to choose. You can have the privilege to be bothered by that because you have your own capital. Right? The rest of us have to put up with it.
Here, let me entertain you. Yes, I'll give you these. Are they right? Oh, I don't know. Well, let's talk about the cars for a minute, or continue. The new car, whatever the interest rate is or isn't, 0 and 1.99 doesn't really exist unless you're in Switzerland or the ECB, right in Europe. But it's like, that's a big deal. That's not really a big deal. I mean, I'm printing the money out of thin air anyway. Does it matter what interest rate I put on there? I'm winning anyway, right? Okay. And we all know that the cost of the finance charge, the cost of whatever it is you're purchasing, if it's at 0 or 1.99, it is built into the item that you're purchasing.
Yeah.
Period. Even though they won't lower the price if you pay cash. No, it's either this, that's the price, and you can either finance it at 0% or...
Well, there should probably be a Parkinson's law discussion about why you're buying a new car anyway.
Well, maybe I wanted one.
Okay, well then it's good to be aware of that going in. It's like, okay, if we're going to go out and we're going to spend, well then, good to keep the alternatives in mind just in case.
No, look, Parkinson needs to be whooped every day.
Yeah.
No question. Yeah, her new car does have leather and seat warmers.
It's a nice car.
Seat coolers,
right.
And all of that. And I don't care. I mean, how many cars is one going to drive over their lifetime? 15, 20? Well, if it,
Wow.
Well, it depends on how long you live and when you started driving. I get all that.
Yeah.
Well, let's say a low end number. Most people are going to purchase. I'm trying to think back on the examples that I've used on automobile purchases. When you ask somebody,
I think it's like every 5 years.
Okay, are you married?
Nope.
Is a listener married? Okay. Does your wife get a new car every 5 years too? You get one every 5 years, and you're buying a car every 2.5 years. How long you been driving? 20 years. How long are you going to continue to drive? You do the math. Mm-hmm. You figure out how many cars you're going to purchase. Just be honest with yourself. Yeah, and don't. Oh well, my uncle gave me the first car. I had to buy the second car, but it was a beater, so I only gave $1,200 or $1,500. Well, the last car you buy is probably going to be $50,000, $60,000, $70,000. I don't know. I mean, even practicing Parkinson's law, right? So I just remember the average family, from the work that I've done in the past, the average family will spend well over $1 million just purchasing a car. Not the upkeep, not the insurance, not the maintenance, just financing an automobile. They'll spend over $1 million for the privilege of driving. Now, if you think about it, if I spend $1 million over my lifetime just driving cars, well, how much of that do I want to finance myself? How much of that do I want to recapture? Or how much of that equivalent do I want to recapture? As much as possible. And maybe I only learned about the infinite banking concept and I'm 30 or 40 or 50 years old. Okay, well, I'm not going to have the opportunity to capture the whole $1 million. I'll be okay capturing 500,000. Okay, into entities that I own and control that are accessible tax-free, passable tax-free, the net death benefit to the next generation or two. Yeah, what's wrong with that? Oh, wait, I got to be able to get past the cost of capital and the interest rate from the third-party lender, and then I've got to be able to realistically get past the internal rate of return. Right? Well, what do I mean when I say get past that? Let's look at the automobile. You can't go borrow money at 0% unless it's an offer, a gimmick, a built-in
scheme.
Scheme. All right, 0% on the credit cards for a time period, and then they're going to go to 24, 22, 19, 29%, plus all the other fees that, in essence, take that interest rate up. And so, I'm buying a new car at 3 or 4%, and I'm financing my credit cards, and I only carry a $10,000, $15,000, $30,000 balance, whatever it may be, but I'm going to get hung up on paying the life insurance company that I partially own because I'm using a mutual company. I'm going to get hung up on paying them 5%. All right. Okay. Yeah. Well, that's a problem that centers in the thinking.
Yeah.
Or the inability or the lack of properly classifying what's going on. Okay.
I think often people get caught up in these comparisons without backing up to what it is we're actually doing, the capital accumulation and use piece.
Yeah, no question, because the infinite banking concept is so much more than just financing everything you do for a purchase or everything you purchase. Yeah. It's much more than that. And look, I'm only going to finance a car. I think my drop dead limit is 5 years, right, on a new car because it was so expensive. I'm kidding. So the time frame, the time period of comparison has to be equal as well. So if we're going to finance one car with the third-party lender's money, and I'm going to finance one car with a brand new policy, the third-party lender is going to look, so much better. Yeah. Because mathematically, that's the lesser cost of capital in that time
frame. Let's blow that up for a minute, so people should hear this. Like when others out there, like the guys online who want to talk about IUL or UL and why these are why they quote unquote perform better than whole life, it's across the board. And critics of whole life, and even those who get it, who are trying to go through that numerical analysis to prove it to themselves, you want to watch out for the shortening of the time frame, right? The illustrations in Becoming Your Own Banker cover the person's entire life, right? Nelson assumes that these individuals pass away at certain ages, right? So he's looking at the lifetime of the individual. An analysis that goes 48 time periods doesn't cut it, right?
Well, no,
and in part 3, Nelson even says, other methods of accumulating capital, like method D, the CD method, where we're talking about the cars, ways of financing the use of a car. We've got methods A through D. Method D is the CD method. Method E is the IBC method. And there's I forget the page number, but a nice illustration where he compares the performance of the two. And there's a higher balance in the CDs up to year 14. And then after year 14, the cash value in IBC starts to run away with it. That dynamic takes place across the board, right? You swap out CD for any other kind of asset in which you might build capital, and that whether you borrow against it or you liquidate it to use it, whatever, swap that out for whatever it might be, assume whatever interest rate you want, it'll perform better in the initial years, and then IBC is going to run away with it, right? And on the other side of things, if we're worried about the cost part rather than the growth part, if we're concerned that a policy loan is genuinely more expensive, we're going to lose more money with a policy loan than we will with a conventional instrument. And if the concern is, well, I probably shouldn't do IBC because I'll lose more money paying interest than I would if I just financed with outside lenders, back up a second and recall that, okay, that might look better for 1, 2, 3, 4 time periods, whatever it is, however many months or years, right? Eventually, though, if you stretch the analysis all the way to its final conclusion and you incorporate all of the future growth in cash value that will come, so long as you pay the premium, then the analysis will look different. Your result will change. The IBC method will virtually always run away with it.
You mentioned that, and I like that. So let's look at it. Let's consider what an IUL illustration would look like, because they illustrate, like every other life insurance illustration, they illustrate over the longevity of someone's life, right? So if you compare a universal life illustration with a whole life illustration, now we're only talking about the accumulation side of this base of our conversation, which is the cost of capital and then the accumulation or the internal rate of return. The internal rate of return on a universal life illustration is always going to look better and illustrate higher than a whole life illustration, right? Now, then we have to get to the accuracy of those illustrations, right? But let's just say we're comparing a universal life policy with a whole life policy, and we're going to finance a car early or some kind of a major purchase early in both of those policies. All right. The time period on the universal life looking better is going to be longer than the CD, right? So the CD, in your example, in Nelson's example, it may look really good for 14 years, and then the whole life policy is going to outtake it, overcome it, and just thrash it.
Yeah.
Right.
Yeah.
Well, the universal life illustration is going to do about the same thing because we're illustrating a higher rate of return, right? Okay. So the universal life is going to illustrate better than the whole life. So it's already going to be ahead. It may be now. I'm just saying it's going to illustrate better through the whole time period. And when we go out to the end of that time period, like to the latter third of that time period, Nelson demonstrates in most of his illustrations that the policyholder, the insured, dies at the end of age 85. That's a full long life, right? Or, relatively. Okay. The universal life illustration, what is it really going to do all the way through age 85, right? And the illustration is going to, in my opinion, it's going to deliver disappointment because it is not going to perform the way it's illustrated. And you're not going to see that until you get further out.
Way out there.
Probably right past your insurability, and it's too late to correct it. Okay. But my point here is that it will outperform even in reality. Okay. We're comparing whole life, universal life, and now we're going to go make a major purchase like an automobile. So the time period that it takes for the whole life to actually overcome the universal life policy is going to be longer than the 14-year time period when you compare CDs to whole life. But then the caveat or the continuation of that, the universal life policy is never going to illustrate less than the whole life. Then it comes into reality of what is really going to happen with that universal, or what are the high probabilities of occurrence to that universal life policy out there in the latter years of someone's life. It's not going to perform like the whole life does because of the construct, which we have beat to death I don't know how many times. The internal rising cost of insurance that you cannot avoid. The only way that's the internal cost of insurance in a universal life policy goes up over your whole lifetime.
Exponentially.
And the only way you can correct that is to pay higher premium and or use the account values to subsidize the increasing cost of the insurance.
Or sell off some death benefit, or a combination of all three.
Yeah, absolutely. All right, so the point that I just wanted to make is universal life is going to illustrate better than the whole life, but in actuality, if we're using these two particular entities to finance major purchases, it will still potentially take a longer time period for the whole life to actually overtake the universal life policy. But at the end, and let me say that would be very hard to illustrate because there's not a financial guru on the face of the planet that's going to illustrate a universal life policy with a guaranteed lapse in the future on the non-guaranteed side of the ledger. Right. Yeah. So then it really gets back to, somebody's playing games with numbers on the page. Or, here we'll justify that by lowering the death benefit in the future. We'll get the cash value and the death benefit closer to the corridor that's required. And I might have gone a little bit too far down that, but I'm just saying, we're comparing it to what? Mm-hmm. So Nelson compared it to a CD. Now we're just talking about comparing it to a universal life policy, and an important point is keeping the time periods the same. There are really only 5 functions in a future value calculation, which is not a math class. I get it. Present value, future value, payment, the expected rate of return, and the time period. Mm-hmm. And if you change any of those in a comparison, you've changed the apples to apples comparison.
Yeah. Yeah.
I hope you found that beneficial, because he's not really impressed.
No, it's good. I mean, it's all good. It is good. It's good stuff. And it is the case that I think a lot of people have one of Nelson's main rules, right? Think long range. Mm-hmm. And they're looking at, because of the nature of these purchases, like the car, where you would think a 3 to 5 year repayment. Okay, well, let's look at that a number of years. Mm-hmm. And all we're saying is, no, look over the course of your lifetime, because, by the way, that car ain't going to be the only thing you're going to buy.
Oh, look, you want to talk cherry-picking time frames. All right, let's look at financing an automobile for 5 years in the 35th year of a life insurance policy. All right, it's hands down. I don't care what you want to compare it with. I'm winning. Mm-hmm. All right. But, okay, so the automobiles, the low or no interest rate is a form of marketing. It's another form of a sinking fund method, that's not even true. The cost of the capital is in the item that's being purchased.
In the purchase price.
And Nelson, we've had many conversations about this. Back in the day, I think prior to 2009, GMAC, General Motors Acceptance Corporation, right? When General Motors, got into financial trouble and had to have a bailout, right? They sold off their most profitable arm, which was GMAC.
The financing.
Yeah. So now you tell me, how can that be the most profitable arm of an organization at 0%, right? Which now has become Ally Bank, right? Oh, okay. So they same thing on Wall Street and the banking. They just repackage, get in trouble, get a bailout with your money, right? Repackage, make a lot of money, get in trouble, get a bailout with your money, and do it again and again and again. Okay. Now we've talked about new cars. 0%, another form of marketing, doesn't exist. Now let's talk about pre-owned. The subprime market or the pre-owned automobile market. And then within that pre-owned automobile world, the financing options that are available there. And, the subprime market, I don't know what the credit scores are required to be before you're out of subprime, maybe in your 400 or 500 credit scores. I don't know. But you look at the subprime market, these automobile dealerships are financing paper that they would not have financed 8, 9, and 10 years ago, right? They required previously a higher credit score or income to debt ratio, and now all of those are coming down. And think about what's going on, all right, across the world, across the face of this planet, right? And just when it comes to the automobile world in the subprime market, years ago, just a few years ago, we had the hedge funds coming in. They're buying up all the paper that they can. They're buying up all the paper they can from pre-owned automobile sales, right? So I'm just saying the subprime market's getting more and more competitive. They started it first. the hedge funds buying all the paper, and then the major automobile manufacturers and their financing arm, they're lowering their standards in financing automobiles. I wonder why all of that is going on. And now, okay, that's just one example. The 0% interest, you're not going to get 0 or low percent financing on pre-owned. You talk about Parkinson's law, which we all have to confront and overcome daily. So now, let's say I've overcome Parkinson's law. I want to buy a pre-owned automobile. Not wore out. Right? I just don't want to lose that first 20% when I drive it off the lot. All right. Can I get a pre-owned automobile financed at 5 or 4?
I've driven the same car for 11 years, so I don't know yet. You're
mastering Parkinson's law. Good job. But that's a major purchase. Right? And then we get into homes. Right, primary residence. We can get into mortgages. That's another. I mean, that's one of the largest things that any of us are going to finance in our lifetime is our home. This raises a good question. You know, people need to be thinking when it comes to these major points in life. You're getting married, you're having kids, you're buying a house, moving out of state, whatever, changing jobs, whatever it might be. A major question that needs to be on your mind, front and center, especially in those major transition periods, is where are you building capital? You know, is it in your house? Is it in the stock market? Are you building capital? Are you saving at all? Right? Kind of, are you building capital presupposes that you're saving. So where are you doing that? Right? And then again, theme of the episode, compared to what? Well, why? Which is better? You know, we're starting to get into the home discussion. We've talked about HELOCs before, home equity line of credit. Well, is a HELOC good to do? Well, compared to what? Compared to a mortgage? Sure. The method of allocation of the interest charges is better in a HELOC than it is in a mortgage. You'll lose less in a HELOC than you will with a mortgage. Okay, fine. But keep going. Compared to a house can still burn down. You're still going to be, do you really own it anyway? I mean, you're going to owe property tax, right? It's just rent to the government. Sharecropper.
Yeah, it'll appreciate and it'll depreciate, right? There will be some sort of upper limit. Your capital won't grow forever there. When you do decide that you need access to that capital, there's going to be certain hoops to jump through, since you don't have a contractual right to the equity in your home. All you can do, you can sell it. You got to find a buyer, do that. But short of liquidating where you sleep, in order to access that equity, to mobilize the financial value in that asset, you've got to get somebody else's permission, which means you're going to apply. There's going to be a loan-to-value restriction, all sorts of documentation, all the time involved, not to mention the interest costs. So that's the mortgage world, and a HELOC can look better than a mortgage, but keep going. Where else might be better? It could be that a paper asset can't burn down, can't really be stolen. It's relational, contractual, guaranteed, right? You do have a contractual right to borrow against it. The underlying value is guaranteed by the lender. I mean, all of the growth, the access, the use is on a very tax favorable, sometimes tax free, sometimes tax deferred basis. A lot of advantages if the question is where's the best place to build and from which to use capital. If that's the question, then you're going to end up at whole life eventually. And it's just going to take different people different amounts of time to get there. That's where you're going to go. And that's the need we're solving. So when compared to what, really, there's not a lot of great comparisons, because it is a whole life is in a class of its own, especially compared to these other products we've talked about, like Universal Life.
Let's great points. Excuse me. Let's talk about a HELOC for a moment, because it's come up, and I don't know why it's come up a lot. I guess because interest rates are falling, right? And have fell. And then, because I see, I see, well, is a first position HELOC better than a second position HELOC? And we've even had a question on this podcast. It's like, do y'all have HELOCs on your primary mortgages? And let me answer that question right now. No, I do not. I personally carry a 30-year mortgage, and I refinance that bad boy often as I want because my equity should not be in the real estate. And if I speak to that for a moment, look,
lay that out again. What?
If the
where are you putting it?
Yeah, right. I have several times did a cash out refi. I know my mortgage is tainted now, right? I'm in Texas. It's reclassified. And look, and wait, and who even controls the tax treatment of interest on these mortgages or these real estate deals? Who controls? Let's think about that for a minute. Who,
it ain't me.
Yeah, it ain't me either. So currently, and I'm not providing tax advice at all, interest on a mortgage is one of the few deductions that are still remain.
Right, for now.
And that's my whole point. When do you think that'll change and how quick? Oh, wait, it's already changing as we speak, how these cash out refis are tax treated. Seek the advice of your CPA. Okay. Let's just talk about this for a moment before I get into the HELOC. We're talking about real estate. A HELOC presupposes that I have equity in my primary place of residence, right? Okay. So what's going up in value in my home? Is it the equity that's going up in value or appreciation? Right? What's appreciating? My equity or the real estate, the cost of the real estate, the value of the real estate? Which one of those are appreciating over this 3% over forever time period? All right. It's the real estate. Now, can I separate the real estate from my equity? Yeah, I can. And so the HELOC is just another form of leveraging my home.
Yeah.
Okay. And then we get, the HELOC. Recently, you talk about conversations that you've had quite often. A conversation that I've had, and this happens to be in a high tax state residence, all right, that hates freedom and private property. But this particular individual, their major asset was their home, just like the average All-American.
Yeah.
The other assets that they have is in qualified retirement plans, just like the average All-American family. All right, and so the majority of their net worth, though, was in their home. Okay, so now let's say I have a home that's, I don't know, valued at $500,000. I have $250,000 in equity. These are my major assets, but I don't have any discipline, so I have a ton of debt. Or I have some discipline, I have no debt. I just don't have a lot of assets that are liquid. I have assets that are not liquid, like my home and my qualified account. And now I'm going to go leverage the equity that I do have, the majority of my net worth. I'm going to leverage the major asset that I own through a HELOC because interest rates are so low. And I'm going to get a first position. And I asked this particular individual, I'm like, well, why did you do a first position as opposed to a second position? Well, it's less likely to be callable. Wrong. Okay. But my point here is this. The major asset that I have, I'm going to go leverage that through a HELOC, and I'm going to take every bit of that liquidity, and I'm going to go buy life insurance and get 90% liquid in day one so I can leverage that life insurance policy so I can go buy turnkey real estate.
Yeah, so it's forfeiting ultimate control of arguably the most important asset this individual
No, we had that conversation of control, and the solution was, well, I'm not going to use all of the line of credit. I'm not going to use a complete
just sell
limit.
3 parts of the house, not the whole one?
No, maybe I have a well, if I have $250,000 in equity, I'm not going to get a $250,000 line of credit per se.
No.
All right, let's say that I'll get up to $200,000 in a line of credit. I'm only going to use 150 of that.
Mm-hmm.
I'm going to keep that extra 50, not use it.
Mm-hmm.
Like, that's going to allow me to maintain control.
Mm.
Anyway, so I hear a lot of that. I see a lot of that. This was several conversations or variations of several conversations that I've had recently. And I'm just saying, who's a rocket scientist that came up with that?
Well, I mean, I get it. People are getting crushed with mortgages, and if they see an amortization table and can read the numbers, who wants any part of that? And so I get that people want to find a better solution. It would help, though, to understand the nature of the problem. And the nature of the problem is lack of a system in which to build capital and from which you can use it. If that were resolved, and by the way, your parents and your parents' parents and your parents' parents, I mean, go back as far as you want, right? It's all too late. We're all catching up, like you've said in the past.
Yep.
So get to it. But that is the problem. If you solve
There's
that problem,
plenty of time, but none to waste.
Right.
I'm just saying.
I mean, you'll ask that question now, like, well, what do I do about X or Y or Z? And if we just treat the symptom rather than cure the disease, then the question's going to arise again. And it's going to keep rising and keep rising. And eventually you're going to get to a point where there is a substantial problem where you do need, or maybe it's a problem, maybe it's an opportunity where you require substantial access to money. It would be good to have the capital and the capital system in place before you get to that point.
Yep, no question.
All right.
Did we make any headway here?
I've said what I wanted to say.
Well, I never say everything I want to say, but I try. I'm just saying.
Well, there's only so many hours in the day.
Okay, well, I had fun. Do you have anything to add?
Nope, all good. Thanks for listening.
Right. Have a great day. Be free and independent.
Thank you for joining us on the Banking with Life podcast. If you're watching on YouTube, make sure to like and subscribe. Otherwise, find us wherever you get your podcasts and subscribe to join us weekly.